Let's talk about how to get rich off tech companies. Should I join venture capital? That is the question at hand. As with all my videos, I'm not saying should I join venture capital, but the rhetorical I. Should you join venture capital? What is venture capital? How do you become freaking rich with venture capital? Venture capital, simply put, belongs in the category of the buy side. Buy side is a term that a lot of finance people use just to confuse you and make you feel like you don't know anything. Buy side. What is the buy side? It just means they have money and they have things to buy and they're going to make money off the things they buy. Largely, in my opinion, in the buy side, there is private equity, venture capital, and hedge funds. Private equity have a lot of money. They buy sophisticated, good businesses, grow them, and then sell them for even more than they bought it for. Hedge funds, they hold things like stock and they trade them, sometimes in short periods, sometimes in long periods. They bet sometimes for the market, against the market, and individual people bet using those assets, and they don't actually own the entire companies themselves. Venture capital is all about startups and the potential to boom, whereas private equity and hedge funds make bets specifically and they expect these things to have a return. And of course, in venture capital, you'd like for all your investments to have returns. The expectation is that many of them, if not most of them, are probably going to fail, and one of them is going to give you the big bucks. So imagine you are Brian Jun VC and you bet on 99 duds, but the one Facebook in 2004, Facebook booms and it carries the entirety of your fund. That is VC's thesis, hypothesis, theory, and goal objective in the long run. Of course, if you're some firm, some entity like YC, the Combinator, and every company you hit just happens to be a bang, then why not? But essentially, you're hoping for that one nice egg to pop and you're okay with the remaining 11 to suffer. Getting a job in venture capital is a little bit tricky / weird because they don't really need that many junior people. A lot of it is about relationship management. Of course, you need the people to run the diligence, do the numbers, make cold calls, and do the dirty work. But venture capital, you just need relationships and the ability to break in and be able to become seed investors, become investors in these startup projects. A lot of the application process is typically directly through headhunters that are emailing ex-investment bankers. I know that a lot of VCs are actually hiring people on the ops side now, or coming from product management, or people just start their own fund because they're freaking rich and they have money to invest and they're not really thinking about necessarily the numbers, because a lot of times the fields, the industries, the companies that these VCs are investing into are exploring brand new areas. There's not even comparables. They're creating things out of thin air. It's like a fugazi. There's nothing that they can do analysis against other than theorizing the TAM. This brings a good segue to this buzzword TAM, which is short for total addressable market. This is a word that is thrown around a lot in the VC world. It is quite literally saying, what is the total addressable market that your company can target? What is the amount of billions and people that your company will be able to pull money from? And this is important because when VCs are investing into startups, they want to make sure that this startup has the feasibility, the ability to target the masses and bring in the riches and make sure that what they're targeting is correctly calculated. So if you're offering a solution for digitalized calendars, for example, you have to think about how many people in the world need calendars, how many people need digitalized calendars, and build from there and come up with some billions of dollars number that could also be a fugazi, but at least be convincing that this is the market that you're going to address. So in essence, getting hired for VC is very hard because you either have to be contacted by a headhunter. A lot of these VC firms aren't really putting out job postings saying we're hiring a VC person. There's not many spots available in the first place, and they don't really need people, at least at the junior level, that much. What does that mean on a hiring process perspective? Speaking to my friends who have been in VC processes, I've heard that it's actually kind of long and strenuous. There's a lot of talking, making sure that you're someone that is involved or understanding of the VC space. You have an eye for investments. You know how to calculate TAM. You can do basic due diligence, do financial analysis, have a finance background. You enjoy investing. Having an ops background, an even bigger plus. If you have a startup experience, also bigger plus. There's definitely going to be a case study, multiple interviews, getting to know you processes, what you think about the thesis of the VC firm itself, anything that comes with typical big finance boy processes, and on top of that, having that tech startup TAM perspective layered, sprinkled on top of it. In terms of compensation, the average associate salary is around the 80K-ish to the 150K-ish mark, depending on where you are, how big the firm is, how nice the firm is, and then a bonus based off that salary as a percentage. Also, depending how well the firm does. If the firm is big, they might even give you money based on how well they do that year. As I've explained before, unlike private equity and hedge funds, which I would argue are a bit more sophisticated on their approaches, of differing opinions on what that sophistication actually means. But in comparison, just based off common logic, VCs have a higher chance, in my opinion, of utter failure because you could be investing in hundreds of companies that all might amount to nothing. It's kind of like you going on Coinbase and investing on all these low market cap cryptocurrencies and hoping one of them will blast off to the moon. Imagine if none of them blast off. What are you gonna do? So as a firm, kind of sketchy. As an individual, not as sketchy. Exit opportunities / upward mobility. Most VC associate programs are limited to 2 years. You even set a contract for 2 years and they expect you to just move on. Or if they really like you, maybe pay for your MBA or encourage you to go get your MBA and come back. Most post-MBA associates as VCs are on the partner track. But as I said before, space is limited at the top. What do these analysts or associates do? Mostly a lot of due diligence, and then sourcing is the hot word in VC. You have to be aware of the startup space and be available and be out there sniping and viping for the next new big thing. And you're not going to know that by just standing around. You got to go to meetups and understand the space and talk to people and know what is hot and what is not and be aware of what to invest next. Obviously, like the sell side process that I was involved in banking, I'm sure that there are companies that directly call on VCs and say, hey, can you fund us? But it's kind of like dating a little bit. I'm going to get in trouble for saying this, but I don't care anymore. I would assume the real hot boys and girls don't go out of their way to reach out. If you want to get hold of a opportunity that you know is going to go big later, or you know of a potential significant other that is high in demand and high quality, you probably want to be the one that's approaching them first. While there might be pitch decks out there might be SIPs and SIMs spreading around for startups saying, hey, we're this company. Majority of the VC associate role is cold calling and seeking out these opportunities in addition to the due diligence associated with it. To close it off, let me talk about why I think being at a VC could be really fun and also why VC could not be fun. I think on a fun level, you get to learn about a lot of different businesses. You get to do some deep dives. It's a little bit less about the numbers and digging into the modeling and the boring finance stuff, but really understanding business models, the TAM, talking to people, a lot of networking. That sounds really fun to me. Not so fun, this uncertainty of any of these failing. You're making pretty big bets on things that might never pan out. I'm sure a lot of VCs start off very strong, high morale, realize all their stuff is not working out, constantly seek the next cool thing, and then it just simply does not work. This could be a uniform statement for all across finance, but it seems like there really is no standard for startup success. I watched a TED Talk recently that said that timing, if anything, is the biggest common attributor to success in the startup industry. It's not about leadership. It's not about the idea. It's really just about luck and timing most of the time. I don't know if that makes the associate or the junior level job less fun, but there is a thing to think about. Am I really contributing to the successes of this organization, or is it just more of timing striking a lightning into our firm and making it successful? One sentence summary of the day: investing is fun, losing your investments is not. As always, I thank you guys for watching. I am going on a little trip next week from New Hampshire to Boston to New York. If you guys happen to be in New Hampshire, which would be kind of surprising. If you happen to be in Boston, which is less surprising. If you're in New York, not surprising at all. Come say hello if you see me on the streets. And I will see you guys next time. Let's go.